Hello friends, this is Raj Sastri from Raj Option Trading. Today is Jan 1st, 2022. I wish you all very happy new year and I wish you can take your game to the next level in Wall Street in 2022. So with that, people ask me how should I invest during high inflation environment. Let's talk about that. It's a big elephant in the room. So with that, let's jump in and get started. So we'll talk about high inflation environment and what we learned from 2018. Then we'll talk about what asset classes will do well during inflation. And then we'll cover what sectors will do well during inflation. And finally, let's look at long-term investing and what sectors we should invest, during this high inflation environment when the stocks are on a sale. So with that, let's jump in and get started. As you look here, we got a high inflation environment back in 2018. We had multiple rate hikes. We have Jerome Powell increased the rate in March 2020, March 22, 2018, and Wall Street did not like it. Stock market came down, and then he again increased it again in June. Again, market did not like it. So in June we went from 1.75 to 2% increase in the rate. So Wall Street did not like it. And then we basically went again and increased in September. It's the third rate increase in 2018 here. And now we are at 2.25. And a final increase in December here. Wall Street did not like it at all. I still remember, this day here when entire stock market got clobbered. There is no place to hide here. Around December 20th or so, we did not have a good, holiday season because market tanked big time. So with that, let's jump in and see what we can do here. And as you look through here, we got Fed officials here. They are expected to increase, rate again in 2023. We are expecting up to three to four increases in 2023. As you see here, 2018 four increases, and 2022 three to four increases. So that's why we got to learn some lessons from 2018 and see what we can do. And also, Jerome Powell made some comments in 2018 here. He said we are a long way from neutral interest rates, and he also made a comment. We're going to overshoot on increasing the interest rate. Wall Street did not like those comments. That's why Wall Street tanked big time in December. Let's learn from it and go from there. So with that, let's jump in here and look at how to invest during high inflation environment. As you can see here, during the high inflation environment, we have several sectors which will do well. Typically, real estate and REITs, they will do well. Think about these utility type REITs; they will do much better, and even the home builders, they will also do well. And then we got your gold, silver, copper, all these type of commodities here. They typically do well during the high inflation environment, even though sometimes it can be muted if the dollar gets too strong. And then you got your consumer staples. Think about your Procter and Gamble, Walmart type stocks here. They will also do well during the high inflation environment. And then you got healthcare. Healthcare is always a steady eddy here. Whether you have money or not, you got to take care of your healthcare. That's why healthcare stocks typically do well. They are a little more resistant to all this inflation at times. And then you got utilities. Think about your favorite utilities. Whether you have money or not, you got to prioritize paying for your utilities here. That's why they tend to do well. And then finally we got crypto, fine art, vintage, tips, all these things, they will do well. Even some selected stocks, technology stocks with low debt and good profit margin and pricing power, they will do well. Many of these companies, they will do much better during the inflation because they can take the share away from other struggling companies and also acquire companies which are not doing great and grow that way. I know many great companies, they will emerge out of this inflation much stronger than they went into. So with that, what sectors do poorly? Typically, sectors like industrials with a high debt load, they will tend to do a little poorly here, and growth stocks also with a high debt load, they will also do a little bit bad. There will be some sector rotation going on. And then finally, we got stocks with no pricing power. They also tend to do bad because consumers will swap out of those shares, and they will go after some generic brand as an example and get the same benefit. So that's the quick cheat sheet for you. Keep this in mind as you invest during the high inflation environment. And if you don't have any allocation in your portfolio around some of these names here, have a small allocation. You still have time. In some of many of these segments are still relatively low. You could still buy some quality stocks in these areas, or even ETFs for that matter, and go from there. So with that, let's jump in here and look at a few more. So from a 2021 performance, we just rounded up 2021, as you all know. From a performance perspective, as you can see here, we had a great 2021. The winner overall in 2021 is XOP here. Think about all these oil, type stocks here. They did very well. Followed by energy. Think about big energy names like Exxon, Chevron. They also did very well. They did very well because coming out of 2020 where people nested at home, and in 2021 economy opened up, people started driving. The comparison was much easier for energy sector in general, both XOP and XLE. Compared to 2020, 2021 was much better. That's why they put up a nice show, as you can see here. And then you got XLRE here, real estate. As you all know, the real estate and even the home builders, they did very well in 2021, mainly because there is a lot of pent up demand for homes. People like to move away from their city or town homes into suburbs and buy a big house. That's why home builders and real estate did very well in 2021. And as you look through here, we got financials did nicely here, 37%, and we got technology also not did very well, as you can see here. And then on the downside of the house, look, Apple is a game changer. Apple did some changes to their privacy policy, and all these communication stocks like social media stocks, they all down big time. Think about Facebook, Pinterest, and Snapchat, and many of these stocks are down, as you can see here. I think there's a good opportunity to buy some of these names here at these levels. And look, we got XLP here, consumer staples. Consumer staples did great, back in 2020. Everybody wanted to buy all these consumer staples and stock up their pantry, and now that fear is gone. That's why they're down, as you can see here. And then finally, utilities is very muted in 2021, as you can see here, because folks went after high risk areas like technology, financials, and whatnot. That's why XLU did not do very well. Even the interest rates was low, but still the profit was much better, performance was better. That's why folks got into high risky areas like technology in 2021. So things might change as we go into 2022. That's what we'll focus on in the next few segments here. So as you look through here, we got performance last 5 years. It's very good to understand how did we do in last 5 years. As you can see here, from a legend perspective, SPY is dark blue, as you can see here. So look what happened in 2021. We got S&P 500 did great here. Look, 29%. It's the best performance in S&P 500 compared to other ETFs in 2021. And then we got here QQQ, which is technology and biotech here. That also did nicely, even though there is some swapping out of these high growth stocks and technology stocks. Still, they did better. And then finally, we got DIA, which is Dow Jones Industrial Average. That also did pretty okay, 22%. And weakest one was small cap. I know many of you might be holding some small cap names, hoping for a bounce here. But I think we'll end up holding those small cap names for a little longer here if the inflation fears still exists, because during inflation typically small caps they might a little bit stay muted. That's why we might have to hold them a little longer. And now turning back to 2020 here. In 2020, as you can see here, technology did very well. QQQ nicely, did superbly well here. As you can see here, all the other indices are so low here, and QQQ did almost 50% in 2020. This is when all these folks are stuck at home using the cloud technology like Zoom and other technology to really work from home and collaborate. And as you can see, our next sector was XL IWM here. Small caps also did very well in 2020. And then you got SPY, did okay. And then finally, Dow Jones Industrial Average did not do well. These bigger companies, they typically need consumers to buy their products. And when the folks are stuck at home, they may not go on a big construction site and whatnot. That's why it's still a bit muted here in 2020. And then you got 2019, again technology did very well, followed by SPY, and then finally we got IWM and Dow Jones. And then a different story when you go into 2018. As you can see here, 2018 was a year when Jerome Powell increased the interest rates 4 times. That's why you see here when the interest rates got increased big time. The low tech Russell 2000, the small cap stocks, fell big time here, 12% down, huge haircut here. And then you got your industrials. Think about Dow Jones Industrial Average down big time, minus 5.7%. And then you got technology. Technology held up pretty well. QQQ, which is technology and biotech, held up pretty well, just 1% down. And finally, as you can see here, we got SPY down 6%. So that's what's going on here. You can expect something similar in 2019 if Jerome Powell increases the rates by 4 times and uses some harsh language. But I don't expect Jerome Powell will do that. This time he's more intelligent. He will be more data driven. I expect maybe 3 rate hikes and some data driven comments versus harsh comment like Jerome Powell did back in 2018. So that's why I don't think we'll end up in this type of situation. But don't expect the gains that we had in 2021 to continue. It will be a little bit muted. That's my take here. That's why it's better to go after companies with nice profit margin, low debt, who can weather this high interest rate and go from there. What I will do is, I will have one more segment either today or tomorrow where I will talk about the stocks we could invest during this high inflation environment. That can give you a good idea. In this segment, I will talk about what sectors we should invest, so that way you got a better idea about the sectors you should be looking at to invest during this high inflation environment. And then you got 2017 here, as you can see here. In 2017, again, technologies did very nicely here, 31%, followed by Dow Jones Industrials did nicely here, 25%. And then finally, we got SPY and we got, small cap here, IWM. So as you can see from this 5-year chart here, typically, QQQ comes out with flying colors most of the cases, as you can see here. It might be dipping a little more during the tough times, during the swap, during the transfer of transfer from one sector to other sector rotation. It feels brutal, but overall QQQ fared pretty well in last 5 years, even during the high inflation environment. In 2018, QQQ did much better. And as you can see here, as you go from a high technology return to a little bit muted return, it still does well, but the returns are a little bit muted compared to the past. As you can see here, comparison perspective, we went from 47% to 25%. But if you compare to other ETFs here, technology did pretty okay here. Still good. You cannot compare the past return pre inflation environment into an inflation environment return. That's why it will still do well, but don't expect high returns like QQQ has given in the past. So with that, let's jump in here and look at a few more details. This could be a little bit eye chart for you. We'll try to talk through it a little slowly. So what I want to do here is really give you a good idea on what sectors may perform well during the high inflation environment. So with that, let's jump in here. As you look through here, let's go back here. So as you look through here, as you can see here, we got a few things going on here. We had COVID back in 2020. As you can see here, this is our 2020. This is the year of COVID. As the COVID hit, as you look here, we got technology here. QQQ did handsomely here, 47%, which is technology and biotech. Just technology, which is XLK here, just technology did superb, as you can see here. And semiconductors did great. Semiconductor did 55%. In during the COVID days, everybody wanted to buy laptop. Kids wanted to study from home. They wanted a laptop. That's why all the technology gadgets were sold big time. Semiconductors were ruling the world back in 2020, along with the technology stocks. And the consumer discretionary or cyclicals also did nicely, as you can see here. Even gold did pretty okay in 2020. On the other hand, energy was very low here. Everybody stuck at home. They didn't want to drive because you don't need to drive when economy is closed. For most part, shops are closed. That's why XLE did badly. And as you look through here, few other areas are in red, which is we got here XLF financials also did not do well. It's again a low interest rate environment. That's why these folks also did not do well here. And then if you go into 2018 here, 2018 is the year of high inflation. As you know, Fed raised the interest rates 4 times here to combat this inflation here. That's why in 2018, the big mother of all the indices here, SPY, down 6.2% here. And look, small cap took it down their chin here, down 12%. You can expect something similar if Fed uses the aggressive tone here. You could expect SPY to be flat to down a little bit in 2022 if Jerome Powell uses harsh words, but I think he knows better now. And look here, Dow Jones Industrial Average also down 5.7%. Semiconductors were also down. Think about this big Nvidia and Broadcom and those Avago and Broadcom. They were down here. And XLI industrials were also down, as you can see here. TLT Treasury, also down. And we got XLF financials also down big time. And we got few more like gold. Even gold is down, but not as much down as you can see here. In a cursory look here, as you look through here, what did very well, during 2018, downturn. We got XLY here. Think about stocks like Amazon, Home Depot, Lowe's. The consumer cyclical stocks did very well here. And then we got XLV. Healthcare did pretty nicely here. And we got XLU. Utilities did nicely here. And gold did not do that bad. It also did okay here. So that's in a nutshell here. Even real estate held up pretty well here. So something similar you can expect this year also. Think about investing some of these areas if you don't have exposure, like XLY here and XLV, which is healthcare and consumer cyclicals, and also utilities, and also gold if you don't have some gold, and some real estate, both home builders as well as REITs. You could invest in those names if you don't have. And then we got here 28 here, 2008. As you can see here, banks collapse. At this time, there is no place to hide. As you can see here, most of these major indices are down big time. As you see here, SPY, QQQ has dropped almost the most here. As you can see here, 41.9. Even technology dropped big time here. But what did very well at this time is TLT here. Your bonds did very well here, and also gold did pretty much okay here. So if the banks collapse and this was subprime mortgage issues, Lehman Brothers and Bear Stearns, all this did not do well. Even the big bank stocks were really single digits, I could remember. So this is a systemic risk. I don't think we'll go into this level here. We'll be somewhat along the lines of 2018, or little more muted if Jerome Powell uses some not so harsh words. I think he will not use harsh words, so it will be something comparable to 2018 as we go forward, or better. And then you got your dot com bubble. For most of you who remember dot com bubbles, I know a lot of people who bought all these high flying internet stocks like CMGI, JDS Uniface, Exodus Communications, for old timers who remember them, and lost a lot of money in those days. I think in those days, in 2000, as you can see here, it's a bloodbath in most of these sectors, as you see here. But looks like in some areas like industrials fared pretty okay here. And even though they also came down later in 2002, but in 2000 I think industrial did well, financial did okay, utilities did great, consumer staples and energy also did well. So this is a quick lesson from the history for the folks. I'm sure many of you remember, but in case you don't, just a quick refresher. As in my opinion, will be somewhat similar to what we have done in 2008 here, or better. And next, what we'll do is we'll look at some more details here. This gives a yearly view. Let's try to look at a monthly view and see what happened as Jerome Powell increased the rate 4 times. What happened and how did we take the blow by blow 3 or 4 times, and then go from there. So with that, let's jump in here and look at what sectors did well during 2018 rate hike. And this is a monthly performance view, as you can see here. We got month by month. Keep watching here. We got all this month here, January, February, so on and so forth. So let's look at the monthly view here and go from there. So I also highlighted here 2018 here. The entire 2018 is in this purple rectangle here. So look, first time Jerome Powell said we are going to increase the rates is around March. March 20 or so. He started prepping the Wall Street in February. Look what happened. The moment he talked about rate hike, we got tough time in some sectors. SPY down big time. QQQ down about 1%, as you can see here. IWM down, and XLV healthcare also came down. It's a bloodbath along. As Jerome Powell is preparing everybody for a March rate hike. Almost all the sectors, as you can see here, did not do well. Exception were Dow Jones Industrials. They did pretty okay here. And probably even SMH semiconductors, they kind of held up, even though they're not up much. So then March came along. We had our first rate hike on March 20th, as many of you know here. And as that happened, we already had the old news, and now news is done. That's why some sectors, some ETFs did a little better here. A relief rally in Dow Jones Industrial Average, and even small cap did well. But XLV did not do that great here. And then you got TLT bonds did pretty okay, as you can see here. Utilities were holding up pretty well, as you can see here, and gold did okay, along with XLE. Energy was doing nicely here, and real estate it also did well, along with financials. And then we got one more rate hike coming up in June. As you can see here, June was second rate hike, and Wall Street did not worry too much about it, because I think it was well known that Jerome Powell is going to increase. That's why nothing much happened. Wall Street took it with a stride, and many of these sectors did well, with the exception of SPY here, and XLI Industrials gave a little bit back here, and gold also gave a little bit back, along with XLE, and few other sectors like XLF, which is financials, technology, and even semiconductors also gave a little bit back. So it's a typical rotation from these high growth names, as you can see here, into names like small cap, and even consumer staples, as you can see here, and few areas like consumer cyclicals and real estate. And finally, we had our third rate increase in September. As you can see here, September and October timeframe. As you look through here, we got a little bit not so great performance in September, October. Especially October is super brutal. Look, SPY 10% down. It's a huge downturn. I know many of you might be remembering those margin calls if you invest in margin. I think we had a lot of those bad news back in September 2018. As you can see here, October 2018, big time down here, 10% down in SPY is not a small matter, and even QQQ down big time. Dow Jones did pretty nicely, as you can see here, and also XLV Healthcare is down big time, and XLI Industrials also big time, which goes along with the some of these big names. And then finally, as you look through here, XLE did not do well, and many of these sectors did not do well, including the technology, semiconductors. These high growth names did not do well. I think maximum hit was in SMH here, and also XLE. As you can see here, those are the two maximum hit, along with XLI here. And then finally, we had one more rate hike that came in December 20th. Keep watching December here, 2018 December. And they announced it a little earlier. Look here. This is a bloodbath in December. We got SPY down 11%. I could still remember those days here. Huge drop in SPY. It sounded like, Wall Street is not going to recover at all, but it's behind us right now. Look, huge drop in SPY, QQQ, and look here, semiconductor down 9%, not too bad. XLK is also down. Financials down big time here. Energy is down big time. So that's what is going on here. So these some of these sectors did not like this high interest rate environment. That's why they came down. Energy and some of these commodities came down because dollar gets stronger as Fed increased the rate. That's why some of these dollar denominated commodities, they did not like it too much. That's why you see some of these commodities like especially XLE came down here. But look, gold was shining at the time, did pretty well. TLT bonds also did very well. Small cap also did very well, as you can see here. And we got few more areas which I think they did pretty well as we go into January, as you can see here. But that's the bounce from this big downturn here. So with that, let's jump in here. In a nutshell, what we can take off is really, when market drops big time, during high inflation environment, go after some good quality stocks with the low debt ratio and high profit margin, and companies that keep growing. You go after such companies here. We'll look at that in our next segment and look at those specific stocks that we could buy. But in this segment, think about if market drops big time, don't be afraid. Go and buy some QQQ, which is a very good ETF to hold on to, and buy some ETFs like XLK, SMH, even XLF for that matter. As they drop, keep buying some of these ETFs. They will serve you very, very, very well. So with that, let's jump in here and look at long-term investing. Many of you like to invest for long-term. Even I do a lot of long-term investments. Even though I also look at some of the swing trading because it's it keeps you engaged. But I do long-term investing. If you're a long-term investor, take advantage of these drops here. Don't be afraid. Keep watching here. We got XLK, which is technology. In last 10 years, technology is highest performer. XLK has done 698%. If you did not invest in a single stock and just bought XLK, you have done nicely here in last 10 years and beat the entire stock market nicely. And same way, if you just bought QQQ here and did not do anything else in last 10 years, you did superbly well here. 698, 89% performance here. Again, did great. And then you got other areas like consumer cyclicals. If you bought this ETF and held on to, don't worry about inflation and stock market falling off the cliff. If you kept on holding it and bought more during the drops, you would have done great here. 495%. The reason I'm trying to bring this up is really, when market drops big time, just buy some of these favorite ETFs, and also some of these stocks in these ETFs. You could look them up easily in Yahoo Finance and look at some of the top stocks in these sectors. That will serve you much much better. Many times what folks do is they will rotate out of the these some of these sectors like XLK, and they will go after, say, gold as an example. Look at gold here. Gold is a good hedge for your inflation, but from a long-term investment, look what it has done in last 10 years, just 13%. So what I typically do is I will have some allocation towards gold in my portfolio, but gold is not my long-term investment like candidate that does very well. Instead, gold is a hedge. As an example, if I want to take some money out in the when the market tanked big time, I would probably trim down some of my gold positions and take some money out that way. So, areas like gold and even TLT for that matter, you might have some TLT ETF or some bonds. Those are the good ones to swap out when you need some money. So that way you have some hedge when the market is down, everything is down. You don't want to sell your XLK or QQQ at the time. Instead, you could trim some of your position in TLT or gold or even XLU for that matter, or XLP, because they will give you that cushion during the market drop off. So that's why it's a good idea to hedge and have some positions in GLD, TLT, XLU, XLP. And when the market does great, these areas will come down. That's a good time to buy some of these. And when the market tanks, they will do nicely, and you can trim some of your position. And that's how you play the game here and go from there. And as you look through here, some areas like home builders, XLV, they will all do nicely here. Take advantage if they drop and buy some of these names here and go from there. And retail has been not doing so great in the near term. As you can see here, you could take advantage and buy some retail stocks into this small downturn here, and go from there. So with that, these are few ideas for you, for the long term investment, and what sectors can do well if inflation raises. So with that, we'll wrap up this segment here. Wait for my next segment, or watch my next segment where I talk about some specific stocks you could benefit from, and go from there. So with that, you might wonder, what should I do now? I heard this whole session here. What's my takeaway? So, if you are in a margin, if you're using a margin, I would say, get out of margin. So that way, when the market drops, you don't get margin calls. And if you need money for next 6 months or 1 year, sell some shares, some of your winners, you could sell them and have some money handy. So that way, when market tanks, you don't sell the shares on a, big loss. And also have to do some hedging when the market when these areas like gold and bond and utilities, when they're not doing so great, buy some of them, have some allocation in your portfolio for these names here. So that way when market tanks, this will give some cushion for you. It's a good hedge against market drop. And also look at areas like utilities, healthcare, consumer staples. They will fare well here, including the real estate. So if when they're down, buy some utilities, healthcare, consumer staples, and real estate. So that way you're prepared, and you have some alternate areas. When the market tanks, they will fare better. And then finally, one of the great strategy is, don't swap into these areas when the market tanks, because at the time you'll be paying heavy dollars. Instead, when the market tanks big time, go after good companies with nice gross margin, low debt. You can get them, buy them at a great sale price here. That's what I typically do. I love to buy these great growth stocks with a low valuation and low debt when they're on sale. And really, they will emerge out much stronger on the other side of this whole inflation. So with that, many companies have got good pricing power. Think about Apple, Costco, Netflix, Amazon. They all have great pricing power here. As these companies drop, including even Microsoft for that matter, as these companies stock price drops big time, just buy them. Don't worry too much. They will be there for a long time to come, and they will do much better. So with that, thank you very much. Happy investing and trading. Please subscribe.